All right, so welcome, guys. In today's lesson, we're just going to be talking about economics and the stock market. Pretty much just going over the major economic reports that are released, like your GDP numbers, your PCE numbers, your PMI, stuff like that, that kind of regularly gets released on a month to month or quarter over quarter basis. That has impacts on the stock market, right? I'm pretty sure if you guys are day trading, you know that we keep mentioning these key numbers that are coming out, and you kind of see in real time once we get a data release, if anything unexpected comes out that's not already priced in, it does tend to lead to big moves in the stock market, right? But it's also important on a swing trading basis just to know kind of where in the economic cycle the market is at, right? It does play a role in certain industries when the economy is booming, when there's a lot of growth and excess capacity is reached in the economy. Then that tends to mean your kind of your technological sector, your more forward-looking, high aggressive growth names tended to perform a lot better, right? But when the economy is like contracting, where growth is kind of slowing down, then your kind of your staples, your more defensive names, kind of do perform better, right? So it's kind of important to kind of gauge where kind of on the economic cycle we are, what kind of key data points are coming out, and what exactly that means, for the economy. What does that mean for the stock market, which does have a direct impact, right? So we'll get started here. Just a quick disclaimer before we do, though. Again, everything in this presentation is for educational purposes only. It's not really considered financial advice, right? We can't provide advice as we're not advisors, but again, we do our best to kind of teach you guys with like a lot of the main things that you can look out for to kind of make your trading a lot better. Okay. Yeah. All right. So we'll talk about stocks afterwards. So just gonna do a quick lesson here. I'll be in the beginning talking about kind of the economics, the major economic data prints, and then we can talk about stocks afterwards, right? So first of all, why is economics important, right? So you still want to reduce the noise, right? As me and Harpreet have said many times, if you're talking about swing trading or if you're talking about a day-to-day basis, right? It is important to cut off like a lot of the noise that we get from the economy, like the daily like Trump tweets on Truth Social, the in and out tariff related news. A lot of the intraday stuff is stuff you can kind of ignore on a day-to-day basis, but it is important to not reduce the noise completely, right? Reduce the volume, but not the noise. So kind of keep intact of what kind of the key economic data prints are telling you, what the kind of key numbers are looking like, because that can help you gauge again a lot of basis of your trade. So it is important to not get too bought up into the day-to-day, but get a general sense of what the economy is looking like, so that can help you position well into a lot of your setups, right? So how companies perform are somewhat reflected by the overall state of the economy. If the economy is growing, then companies will start to outperform, leading to higher valuations. And if the reverse, then companies will start to contract on lower demand, right? If you're starting to see, consumer spending is rising, if GDP is growing, then those are signs that the market is expanding, that, more demand is being acquired in the market, and that demand will start pushing up prices, right? So you can look for more of your growth related names, you can look for more of a bulk kind of market, and the opposite if prices are contracting, right? People are spending less. If GDP is dropping, then that tends to be less spending in the markets, and that could lead to a contracting stock market on the vice versa, right? So it is very important on a swing trading basis, and in day trading, it's important to be aware of times of this increased volatility or sudden price shocks, right? Days where you get like FOMC meetings, days where we have CPI prints, or major economic data prints that we're going to get pretty much every day this week. It does tend to lead to very large price swings on the intraday basis. So it's very important for the day traders. The stock market also as a whole is a forward-looking indicator, right? Which means that it's pricing in information in real time as soon as it becomes available, and inferring what that will mean for the economy at least 2 quarters from now, right? So what that means is that as economic data becomes readily available in the market, the stock market is digesting that information, and through kind of factors of demand and supply, we're seeing kind of it lead the market in one way or the other, right? So the stock market does tend to be a leading indicator, meaning that if you're kind of seeing the market kind of bustling and moving to the upwards direction, a lot of analysts and a lot of forecasters are projecting that the economy as a whole is going to be healthy 2 quarters from now, right? If the stock market is dropping, then it tends to indicate that maybe 2 quarters from now, due to whatever is going on in the economy, whatever political issues going on, that could lead to maybe a decline in future outlook and future forecasts, right? So a lot of things do affect the economy at any time, right? Typically, like as long as as you study more about what's going on in the economy, kind of keeping up with news and day-to-day events, you'll start to see that there's tend to be periods where there's one large sort of economic event that's kind of controlling a lot of these factors, right? Like right now, the major economic effect that we're seeing is Trump and with these tariffs, right? We're kind of getting day-to-day tariff-related news, right? First, we're getting 15%, 30%, deals with China, deals with EU. A lot of that is kind of being in the political headwind. So you're seeing kind of market economists focus more on things like your inflation numbers, things like on your prices, things like that's why the Federal Reserve, with these interest rates and this FOMC meeting is so important because you have now Trump putting so much pressure on Fed Chair Powell, right? So you'll see at different times as we go through like different stages in the economy, typically on a quarter to quarter basis, you'll find that there's some sort of wide arcing economic event that is controlling a lot of the data that we're seeing. So you'll see kind of markets as this data is coming out, as more information is coming about that certain kind of issue that's going on, you'll see the market kind of price that in pretty quickly, right? Like when we got the first tariff-related news, right, back in February, as soon as those tariffs were announced by Trump, we saw markets on a huge decline to the downside, right? But then as they became speculative that, the tariffs may not be that bad, that Trump might keep delaying the tariffs coming out, you're seeing the market kind of pricing in that, okay, these tariffs aren't actually happening, or they're a lot better than what was initially priced in on that fear, and they're seeing that push back to the upside, right? So the market is a leading indicator. It does look forward. So a lot of the data prints that we're seeing, when you see the numbers come out as expected, well, that means it's already been forecasted into the current prices, right? It's only when you see your kind of unexpected data, your surprising results, which could then lead to those big price shocks in one way or the other, right? Because that's what the market isn't really expecting, right? So as the economy kind of goes in these cycles, you'll see that different stock groups get favored, right? During times where the economy is booming, if there's some fundamental reason that it's inspiring growth, it's inspiring demand, we're seeing a lot of the indicators, which we're going to go over in this lesson, if they're kind of pointing in the upwards direction, then you're going to see your growth related industries start to perform a lot better, right? Your cyclical names like your industrials, your financials, they'll start to kind of outperform, while things like your staples, your commodities will start to decline, right? And in times of contraction where things aren't really looking so hot in the economy, then you'll start to see kind of your favor in your commodities, in your like gold prices, your crude oil prices, and in your more defensive, your more consumer staple type names, right? So that's kind of why it's important, right? It's important to gauge where we're at in the economy, and it can also help you in making a lot of your investment decisions, okay? So what are the major economic reports, right? So we'll kind of just go down the list of the major economic data that are out, and then I'll kind of put it all together to kind of infer what type of state of the economy that we're in, right? So the first major data point that we're going to talk about is GDP. GDP stands for a gross domestic product, and pretty much the definition is it's the market value of all the final goods produced within a country, or it can be determined as the total income that is earned by the total households, companies, and the government within the economy, right? So this is pretty much just a measure of economic activity. So what does it kind of mean? So basically anything that's produced within the country, like say that in Detroit there's a factory and they make a car, whatever that final cost for that car is will be included in that country's GDP, right? So anything produced in that country, in those countries' borders, will be counted towards that gross domestic product, right? And it's just a measure of economic activity. When GDP is rising, that means that businesses are using capacity. That means they're hiring more, they're purchasing more materials. There's demand for their products, so they gotta constantly produce a lot of the goods, right? GDP is kind of the sole reason, or kind of the main reason, or that Trump is stating that these tariffs need to be put into place, right? Because with these tariffs, a lot of these countries, a lot of these companies, he's saying can avoid them if they produce in America. And why? Because that will increase this GDP number. It will show that the economy is thriving. It shows that the economy is healthy, and that's all he really cares about, right? As long as GDP is growing, he's happy, right? So that's why GDP is important, right? When GDP is growing, when it's in times of upside, that inspires consumer demand, it inspires growth. The stock market starts to move in the upwards direction, and it inspires more forward-looking analysts, right? So things like your high-risk growth stuff, will start to go up because it shows that there's that demand in the economy, right? If GDP starts to fall, then that shows that there's contraction. That means businesses aren't spending enough. That means companies aren't really meeting that max capacity. There could become employees that get laid over, and that could show that that there's not much spending, there's not much income being earned in that economy, right? So GDP kind of a direct measure of pretty much the economic activity that's going on within that country. And we get GDP pretty much on a quarter-to-quarter basis. It's updated, but we get GDP numbers pretty much monthly, and they typically take place at the end of the month, and they are lagging indicators, right? So, for example, the GDP numbers that we're going to get tomorrow, they're going to represent for the month of June, right? So they represent the previous month, but there's kind of three reports that come out. So in the first month of the quarter, you're going to get the preliminary quarter-over-quarter number. In the second month of the quarter, you're going to get the month-over-month change. And then in the last month of the quarter, you're going to get the advanced quarter-over-quarter, right? So pretty much just measure of that GDP growth from a month-to-month basic, and then we get that final growth number in that final in the final month of that quarter, right? So we'll see how tomorrow's number come out, as it will represent the June month, which is the end of the second quarter, right? So it'll be a pretty interesting number to see, given that we did get a decline in the first quarter. So if that trend continues, again, that could show that the economy is kind of contracting here, right? So that is GDP, pretty much just measuring, is the economy moving? Is there demand? Are factories, booming? Is there production being happen? Is the throttle on the gas, right? Is the company accelerating, right? The next key numbers here, core PCE, CPI, and PPI. These are all inflationary measures, right? So pretty much they measure the change in price either on a month-over-month basis or on a year-over-year basis, right? They're separate numbers that give out key data points. They usually, when they come out they come out monthly, typically around in the middle of the month, and they do represent month-over-month numbers as well as year-over-year numbers, right? So the first one, core PCE, this one stands for personal consumption expenditure, and pretty much they're all measured the same. They just use a different variety of goods in their basket when they're calculating that price over price difference, right? So pretty much they take like a basket of goods that the consumer will spend. This could include food, energy, oil, shelter, rent, stuff like that, and it pretty much determines what that change in the price for that good was from this month to the previous month, or from this year to the previous year, right? And that difference gets included in the inflationary measure, right? So when you're seeing kind of core PCE or CPI higher, that means prices are rising in that time period, and that could mean that the inflation is rising, right? And inflation isn't a bad thing, right? I know everyone says, oh, inflation is high. That means that, that the economy is not doing well, but what inflation measures is pretty much how the economy is working, right? If the inflation is high, if prices are rising, that means the economy is doing well. But the issue becomes when inflation is rising at a higher pace, then consumer household income is rising, right? If households don't have the sufficient of income to purchase a lot of the goods due to inflation, that's when it becomes an issue. So inflation isn't a bad thing, but when it overheats, when it rises too quickly, that's when you kind of have the stock market kind of pull back a little bit, because they're expecting the Federal Reserve to increase interest rates, which we'll also talk about in a bit, right? So inflation and interest rates kind of work hand in hand. So we'll talk about what the kind of Federal Reserve's role is in all this. But again, just with these inflation numbers, just note that it has a direct impact of prices. It pretty much tells you the change in year over year of the dollar value. If CPI, if PCE, if these are rising, then that means the US dollar is also rising, right? So pretty much a strong inflation gauge. PPI is a bit different. PPI is a measure called Producer Price Index, and it's just a change in price of finished goods and services that is sold by producers. So from like factory to factory, from business to business, like raw material going into that finished product, those prices will be considered in your Producer Price Index, right? So it's also an inflation gauge. It's also measured on a month-to-month basis, and again, depending on what kind of major economic news is out there, or what the kind of political landscape looks like, it does defer to what kind of interest is placed on CPI or PPI, right? Right now, because there's a heavier emphasis on production, on these tariff costs and stuff like that, we are seeing kind of PPI get more of a weighing. So typically, you see higher market reactions based on that PPI number in this market. Oh, sorry, I think someone's mic might be open. Okay. So yeah, so these three numbers, they each measure kind of a key data for inflation. CPI, PPI usually tend to come out in the middle of the in the middle of the month, and then the core PCE numbers tend to come out typically towards the end of the month, along with your GDP numbers. Okay. The next major economic report here is retail sales. Retail sales measures the change in total value of sales at the retail level. And this measure is pretty much used to determine consumer sentiment, right? If consumers, if households are spending more, if they're shopping more, if there's buying more goods, buying TVs, buying cars, stuff like that, then it shows that they have a positive outlook on the economy, right? That they're more inspired into growth. So your high risk, your growth names will tend to do well, right? So just a simple measure of consumer sentiment. If we're seeing households start to kind of spend less and save more, then that tends to be a negative outlook for the economy, and it could kind of hurt the stock market, and we could potentially see some downside. All right. So these are some of the major economic reports. Again, we'll go over each of those in more detail. I'll show you guys the resource that I use to look for those, but kind of gauging what the health of the what the economy of that country is, right? If the country has good GDP, if inflation is rising steadily, and is seeing a strong retail sales, then that shows strength in that economy. That shows that your more cyclical names could tend to do a lot better, right? If we're starting to see GDP contract a little bit, if we're seeing inflation rise above expected levels, if it's kind of overheating, or if we're starting to see retail sales decline, then this could show that the economy is contracting, that there is a bit more concern with the economic outlook, and the stock market being kind of a leading indicator could start to kind of pull back here prematurely, right? So again, all pretty important numbers that do have a direct impact and can tell you a bit about what the economy is looking like. Oh, it is frozen. Oops. Okay, sorry. Thank you for letting me know. Sorry, guys. Just using a new setup here, so I have it on a separate screen. I just thought it was changing while I was pressing this. Okay. Well, anyways, this is the key numbers. Again, this slide will be also available to you guys, so I will share it as well in the education channel. But again, this is pretty much what I was going over. So GDP, gross domestic product, your core PCE, your CPI, PPI, and retail sales. So major measures there. Next key factor is the jobs market, right? The jobs market kind of plays a direct role in the economy as well, for two major reasons, right? Because it kind of gives you a sense of what businesses are doing, right? If businesses are looking to hire more, if they have excess capacity that needs to be filled, they're focused on growth, and they're increasing either earnings, or they're increasing their amount of workforce, then that could show that there is a positive outlook for the economy, that more of your growth related names will tend to do well, right? But if they're showing that that businesses aren't hiring, that rather they're kind of going to excess capacity by making workers work overtime and then resulting in layoffs, then that could not really bode well. That could be a signal that maybe the economy isn't really showing signs of growth and is actually contracting, right? And the second reason why the kind of the jobs market is so important is because it has a direct impact of household spending as well, right? If more people are working, if wages are rising, then that means people have more disposable income. And as you build more disposable income, you're either using for that two reasons, right? Either you are spending more, you're buying your car, you're buying a house, you're buying furniture, whatever have you, or you're saving it and you're putting it into like your high risk growth, possibly equities, possibly bonds, but resulting you're kind of investing or you're saving more as well. So if kind of has a direct impact in those two major areas, right? So one can tell you a bit of insight of what businesses are looking like, what their outlook for the economy is, and then second, it can tell you directly what the consumer is capable of, what kind of disposable income that they have, and is that also inspiring growth in the economy or not, right? So the major jobs that we look at typically comes out on the first week of the month, right? So now it's kind of an odd situation as well. We're technically in the first week of August, right? August 1st kicks off on Friday. So for that reason, we're getting kind of trickled in with your GDP, PCE numbers, a lot of the jobs numbers as well, right? We're going to get non-farm payrolls on Friday, and we're getting a lot of these jobs numbers scattered throughout the week, right? So the first one, which we got today, was the JOLTS job openings, right? And JOLTS job openings pretty much as what it sounds like, is the number of job openings that are present on a change from a month-to-month basis, and pretty much it measures job creation, right? If job openings are rising on a month-to-month, that shows forecasts that businesses see a positive outlook in the economy, that they're hiring more employees to meet some sort of excess capacity that they can then use because they need that workforce to meet the growing demand, right? So if JOLTS job openings is rising, then that is a good signal that the economy is overall pretty healthy. But if we're seeing job openings decrease, then that means businesses are contracting, they're looking to spend less, save more, and that could lead to some negative outlook as well. All right. The next number is the ADP non-farm employment change, which we'll get tomorrow morning. And this is pretty much the estimated change in the number of employed people. And it provides an early outlook to the government NFP, which we're going to get on Friday, which is pretty much the same measure. But the key difference is the ADP includes more of the private sector, while the NFP number that we're going to get on Friday, the government issued one, includes more of the government related sector, right? So there's a lot of speculation that this number is also manipulated by the government, because it does tend to report like a lot more than what's expected, and they do tend to revise this number a lot as well on a month-to-month basis. But pretty much the ADP non-farm employment change and the NFP number that we get on Friday is pretty much just telling you the estimated change in the number of people employed, right? If more people are employed, if more people are working, right, there's more disposable income to be spent in the economy, and that's also a sign that businesses are growing, right? So key number there to watch out for. The next number is the weekly unemployment claim. So this number comes up pretty much every week. It is one of the more quicker updated numbers, and it comes out every week on Thursday before the open, right? And it's pretty much just a measure of the change in the initial unemployment claims that are claimed by individuals, right? So the initial claim, so the week over week change. So if you're seeing more and more people claim unemployment, that means there's less people on the workforce. Businesses might be laying off, right? Not hiring that many employees, and that doesn't really bode well for the economy, right? So if there's more unemployment claims than expected, or if there's a trend where unemployment claims are rising, then that could bode a negative outlook for the general economy. And if unemployment claims are decreasing, that means more people are working, and that could be good for the economy. Okay. Next, you have the average hourly earnings. This is pretty much the change in prices paid for labor. So the change in wages, right? So directly impacts that disposable income factor. So if we're seeing, average hourly earnings increase, more people have money to spend. They're looking that the economy is growing. They're probably gonna, put it in, their 401ks, their investment accounts. They're gonna, spend it on that new car. Businesses are gonna gain benefit from that. So it's generally bodes well for the overall economy, right? But if the average hourly earnings is decreasing, then that shows that they have less disposable income, and for that reason they'll save more, right? They'll tend to not take heavy risks, not really spend, on that car. Businesses will kind of decline from that. And in terms of their investments, rather than going into, the more riskier, stock-based names, they'll tend to go into some of your safer, where the principal is kind of guaranteed, right? So it does have a direct impact on the overall economy there as well. And then the next number, the unemployment rate. So the unemployment rate is the percentage of total workforce that is unemployed and actively seeking employment in the previous month. So again, they're unemployed, but they're actively seeking employment, right? So that means if the unemployment rate is rising, there is that supply, that labor is there, that it wants to work, but it's just not being met with the demand, right? And that could lead to a fall off in wages. It could lead to a hurt of the disposable income factor there as well. So we'll have to see, again, we're going to see unemployment kind of at a steady rate. Right now, the Fed mandates an unemployment rate of 4.2% being kind of as a steady number. If it overheats, then that means more people are unworking, then there's not enough businesses to meet that demand. If the unemployment rate is too low, that could also be pretty negative, right? If it's too low, that means there's not that much supply of workers, which means that current individuals that are in the workforce can start to demand higher wages, which could impact businesses negatively, right? So you want to have a steady balance with the unemployment rate. And again, right now the Fed is kind of having a mandate of the unemployment rate to be around 4.2%, right? So that's what kind of keeps them inside of their decision policy making, right? So again, pretty much, these jobs numbers reported on the first week of each month, and they have a direct impact on households, measuring that disposable income, as well as businesses forecasting, if they're able to meet that capacity, if they, have a good outlook on the economy, right? So the next thing, major economic report is the Federal Reserve and interest rates, right? So what is the Federal Reserve? The Federal Reserve is pretty much the central bank of that country, right? So in Canada, we have a central bank. In America, it's the Federal Reserve. The UK has a central bank. EU has their central bank. And pretty much what the central bank is in charge with is with controlling the money supply, right? The bill printer, the money printer supply. And it's also in charge with controlling the interest rates, which mandates to kind of regulate prices within a set goal. and stabilize the job market, right? So right now, the Federal Reserve in America has two major economic measures that it uses, right? Right now, core PCE, they say that the inflation measure from a year-over-year basis has to be at least 2%. If it's higher than 2%, then it could be signals that the economy is overheating. And they have a mandate to keep the unemployment rate at 4.2% as their goal is to maximize employment as well, right? So those are two main mandates of the Federal Reserve in America. Different reserves, different central banks have different mandates as well. But typically, it's to control prices so that they don't overheat by using factors like interest rates, by using things like the money supply, right? And pretty much how they do that, right? If you think about it, how they can kind of control interest rates is if they keep interest rates say higher, right? They kind of control what businesses are required to lend out to individuals and to other companies, right? So, for example, like the Federal Reserve will put in the federal funds rate, which is at 4.5%. Then the private banks will take that 4.5% at a prime rate, and that prime rate is what they will use to kind of give out their loans, give out the mortgages, and what investors can receive if they would invest, right? So, if the Federal Reserve increases the interest rate, then what will happen is that businesses, or typically your small caps, will tend to borrow less, right? Because they'll be paying a higher cost for that borrowing, for that money, right? So to fund their projects, it'll be a bit more expensive, and for a lot of these small caps, it might not make sense, which deters a lot of investing. It deters a lot of growth, right? So typically, your high risk growth names, your small cap names, will tend to start to fall in a higher rate economy, right? And it tends to contract the economy. And from an individual perspective, right, if the kind of rates are higher, then you tend to also spend less, right? You can't really buy a car, you can't really buy a new house, and also you tend to take money out of your higher risk growth equities and say put it into things like your GICs or your bonds, which will give you a better rate of return, right? Because typically the prices for these things will tend to drop when interest rates are higher, and that will give you a more return on your investment as you get higher interest payments on that as well. So kind of has a double-edged effect where if interest rates are higher, it tends to kind of slow down the economy, right? But if interest rates are lower, and kind of why Trump is pushing so heavy, for the Fed to decrease rates is because for a couple of reasons. The first reason is that it stimulates growth, right? If interest rates are lower, your small cap names, your high risk names that need funding for a lot of their projects will tend to borrow more because pretty much the cost of money is a lot cheaper, right? So it inspires growth. You'll see kind of direct impact on the equity markets. That's why when interest rates go lower, you tend to see equity markets rise. When rates go higher, equity markets tend to fall, right? Typically has an impact on your small caps, on your Russell 2000. The second reason why is because it also decreases the value of the dollar, right? So when interest rates are higher, when the Fed hikes rate, you see the dollars tend to rise. When the interest rate lowers rate, the dollar tends to lower as well. And the reason why a lower dollar, why Trump might want to see the dollar lowered, is because then it stimulates exports, right? If the dollar falls in relation to a lot of other currencies, then those currencies will tend to purchase more U.S. goods, right? If the dollar is too heavy, it becomes too expensive, then that defers a lot of international investments. So a drop in the US dollar will increase investments, and you have Trump right now on a like made in America, and then distribute it out to these countries. So if the dollar falls, it increases more demand for these US goods. And the last reason why is because it has a direct impact on the bond market, right? If you lower interest rates, you increase bond prices. So two factors. So just going backwards. So if say the Fed will decrease interest rates, right? This will make kind of current existing bonds that have a fixed rate that is out issued in the market, it will make them cheaper, right? So the current debt which the America will owe will fall substantially lower, and it will increase the amount of the prices for newly issued debt, right? So when they issue the new 10-year bonds, the new 30-year bonds, if it does it in a lower interest rate environment, they could pretty much get more on the principal for those investments. So they get more cash really quickly. And right now, Trump needs that because it needs that to kind of fund his big, beautiful bill, right? So that's why he wants interest rate lowered. So pretty much he can get more in the loan market. He can reduce the dollar to increase the exports, increase demand for U.S. goods, as well as, stimulate the overall economy, right? But again, the Fed, and that's why independence is so important because of these factors, right? If the government wants to kind of push their political favors, they want to push their political party, their own agenda, then they can easily have an effect off these interest rates and affect these things kind of directly, right? It kind of leads to a lot of biases being put in place and by force, right? So that's why it's very important for the Fed to be independent. That's why you have so much of this, back and forth being going forward between Trump and who he's going to sign as the next Federal chairman, right? So. Very important stuff. Again, right now the Fed, as long as they stick to the mandate, that's why they have that goal in place to ensure that inflation is at that 2% and to make sure unemployment is at that 4.2% mandate. Right? They're not really too much concerned with any sort of political flavors. Okay. So typically, how we get information in the stock market about the Federal Reserve is twofold, right? First, we get the federal funds rate that is released, and then second, we get a FOMC meeting which takes place, right? And the FOMC meeting is a meeting that takes place about 8 times per year, where the Fed members, each members from different states and different districts, will vote on an interest rate decision, right? Do they want to raise rates? Do they want to keep rates the same? Or do they want to drop rates, right? And then after they make the decision, the initial statement will come out. So you'll see kind of tomorrow in the afternoon at 2 p.m., at 2 p.m. Eastern time, the Fed will make their interest rate decision and they'll release an initial statement as well, right? And depending on what the interest rate decision is, you'll see the impact on the markets kind of directly. Right now, pricing in that there is going to be no rate change, but if Powell and the Fed decide to maybe drop rates or do a rate cut, that could stimulate the economy. You could see a direct impact on your Russell, on your equity markets, on your high risk growth names. Could get some favor from that from the upside. So first they drop that interest rate decision and they also put out an initial statement of why they came to that decision, right? So why they made that decision, what their economic outlook is, what was the reasoning behind it, and off of that the market then infers, because it is forward looking, you do tend to see a reaction off of that as well. Then at 30 minutes after the interest rate decision is made, we'll then hear from Federal Reserve Chairman Powell. He'll come out, he'll make these statements once again verbally, and then the media will ask him questions, right? And it's during this question Q&A period, questions can range from what is the Federal Reserve independent? Typically, it does get very political during this Q&A period, but typically, as he answers questions, you will see the market try to infer whether he is being hawkish or if he's being dovish, right? And there's actual algos that are out there that will kind of track the words that he's saying and kind of put together, okay, if the words he's saying is a bit more hawkish, then that could tend to, be very strict on monetary policy, which could hurt the economy, could hurt the stock market, and they'll tend to look for short trades. And if he's making more comments that are dovish, that could be beneficial for the economy, beneficial for the stock market, and they'll tend to look for long trades, right? So after this Q&A period, after the initial statement, the markets try to infer if he's being hawkish or dovish, right? And what does that technically mean? So when the Federal Reserve is seen as being hawkish, that means they're employing some very strict monetary policy, right, to reduce growth. They're increasing rates, they're reducing the money supply, right? And that could lead to, again, a contraction in the economy, less focus on your kind of high risk growth names and more of a focus on kind of your staples and your commodities. And then if the Fed is being a bit more dovish, that means they're employing more loose monetary policy, that they're undergoing what's called quantitative easing, meaning that they're putting money into the kind of stock market, into the bond market. And it also could be that they're lowering interest rates, right, to increase consumer spending. So being hawkish pretty much is being short in the market, and being dovish is you're looking a bit more bullish on the market, all right? So talked a bit about the rate hike as well as rate cut. So that's pretty much the overall perspective, right? So I hope you guys get a bit understanding of how kind of all this is related. Inflation, tends to be that major gauge. So if that's why the market plays such a close, eye on those CPI numbers, on those PCE numbers, because if inflation is rising higher than expected, then that leads them to infer that, okay, the Fed is probably going to leave rates up to mitigate some of those inflationary pressures because they want to cool the economy, right? So by keeping rates higher, they reduce the amount of money that's being circulated, which will then cool down the inflation number, right? And if inflation is kind of too low, then they want to stimulate the economy, then that could lead to the market expecting, cuts to be happening. And when cuts happen, then that could really stimulate the economy to the upside, right? Like right now, you do have a lot of the market expecting, at least a rate cut, maybe not to happen tomorrow, but to happen at least twice this year, right? One in September and one potentially later in November or December, right? And that optimism is what's kind of also pushing markets here near all-time highs. So it does tend to be a direct factor, but you can kind of see how all these things are kind of linked, right? And if things like your GDP, your retail sales, if GDP is growing at a faster rate, if it's maybe growing too quickly, that could also bode well that maybe inflation will start to rise, and then have an impact here directly on the markets as well, right? So hopefully, again, that kind of made sense. I know it kind of went over every bit of everywhere, bit of everything, but again, all this stuff is intertwined, and does play a role kind of in the stock market as well. And we'll kind of talk more about it if you guys are in the member section. Again, you guys already know day to day we talk about these economic reports that come out. We kind of give an infers as well as what impact they'll have potentially on the equity markets, right? But pretty much as a whole, once you put all this together, right, you can refer to where we are exactly on what's called the economic cycle, right? So typically the economy does follow this kind of cycle where they undergo a period of expansion, they reach a peak, then after a peak they start to contract a bit, and then they reach a trough and an early recovery, right? So kind of like a parabolic or like a wave, right? So expansion, the market's rising, it reaches a peak, a point of an exhaustion, then it starts to contract, then it reaches like a max loss, and then it starts to revert back to the expansion stage. So most economies do follow this cycle, but the kind of timing in each period does tend to change, right? Economy could see itself like in an expansion phase for like say 3 to 5 years, reach peak for like say a couple months, and then maybe contraction for like a month, and then a trough could only be like a couple of years, and then back to expansion, right? Like I'm just giving examples, but it could be random, right? But typically it does follow into this. So first you do have expansion, peak, then you have contraction, then you have trough, but the timing of each period and the interchange in between each period is could be a bit lenient, a bit unclear, right? So pretty much how you can tell which stage of the economy is by looking at kind of the economic data that we just went over, right? So in an expansion phase, you typically see that GDP is starting to grow or is expanding. You start to see the unemployment rate start to fall as businesses are looking to hire more to meet additional demand. You see that inflation is low, but it is starting to rise. It's getting a bit heated as, money is starting to circulate hands a bit more. Consumer sentiment starts to rise. Interest rates are low. The Fed is holding steady at these low rates, but they're starting to see a bit of concern of the economy, right? They're starting to be a bit more hawkish on their commentary, but rates are still at low levels, right? So typically in an expansion phase, when you start to see these economic conditions, then typically the industries you want to invest in is your technology, is your high risk growth names, right? Like your ArcQQ, like your heavy forward looking, like your symbiotics, like your robotics companies, like your nuclear names, your quantum computing names, those kinds of names will start to gain favor in these types of markets, right? Your industrials, right, will look favor. Your cyclicals, like your materials and your financials, pretty much if you can think about it growing with the economy, those industries tend to do well, right? Your forward-looking, your future-oriented names tend to do well, and your commodities not so much, right? Then after an expansion phase, you reach a point of peak, and in the peak, GDP is still growing, but it is starting to kind of flatten out. The unemployment rate is very low, but it is also starting to kind of stagger a bit. Inflation is rising rapidly. Fed is kind of starting to now rise rates as well, starting to be a bit more hawkish, and consumer confidence is still high even at the peak phase, right? In the peak phase, commodities will start to do well as the Fed, starts to kind of raise rates, trying to kind of meet with the heating economy. You did tend to see commodities like your gold prices, your crude oil prices, your food related names start to tend to do well. Materials and industrials will do well as well because if economies or businesses are trying to forecast that we might see a contraction in the future or that interest rates might rise further, then they tend to do their big expenditures early, right? If they're buying a new factory, if they're buying a new warehouse, a new trucks, then and they expect that rates to be higher in the oncoming months, then they tend to potentially load up on that supply, that capacity early on. So you can see trends if things like durable goods spending starts to rise. That could be a bit concerning as well for the overall economy, right? So your technology and your growth plays will also still do well. Like you could still find good opportunities that are present, but the opportunities will be pretty scarce, right? I think someone's crying. All right, but yeah, so pretty much in the peak, right? In the peak, your materials, industrials, will tend to do well as companies try to forecast for that tend to failure, so they tend to purchase more factories, more excessive capacity, pretty much to get ahead of the curve there, right? And typically your technology or growth plays tend to be pretty scarce. You could still find some decent opportunities, but they will tend to be less discoverable. You kind of see a lot of the names like we're seeing now being extended off their rallies, possibly contracting, possibly holding just above those key averages, right? So markets also tend to become a lot more volatile, but they also tend to be heavy range bound, right? After a peak, you'll then start to see the economy start to falter a bit, and in that period, it's called a contraction, right? So GDP starts to drop, indicates negative growth. Unemployment starts to rise, inflation, starts to peak and then starts to kind of come down a little bit. Consumer confidence is low. The Fed remains steady, but it starts raising a dovish commentary, right? Kind of like what we're seeing now, where federal rates are still at elevated levels, but we're still seeing the Fed, saying that if these tariffs weren't in place, if the outlook wasn't so bad, they would already be reducing rates. So they're still giving dovish commentary, but rates are still pretty elevated. We'll see if they start to falter here as well, right? Say in this environment, your kind of safer industries, you tend to perform better, things that are immune to your cyclical trends. So you'll start to see things in growth, start to see growth in names that are related to kind of your staples, your healthcare, utilities, and your commodities like your gold or your crude oil. Pretty much like essentials, right? If you think about like if we were to everything was completely wiped, what are the bare essentials that you would need to survive, like your food, like your water, right? Things like that. Those things, your healthcare, right? Your utilities, right? You still need heating in the house even when the economy is doing bad and it's kind of cold in the winter. You'll still need to have the heat on, right? So a lot of these things that are not really focused on cyclicals, they don't really go with the overall demand, but our basic necessities tend to do well in this type of environment, right? After a contraction phase, you then enter the trough, the lowest of the low, where you start to see the economy in that early recovery phase, right? So in this stage, the GDP starts to stabilize. Unemployment is still high, but it starts to kind of flatten out. Inflation is low. Interest rates start to fall. Consumer confidence starts to improve, right? And then in this stage, you can start to focus more on your technology, your consumer discretionary. In this phase, you're kind of looking for those relative strength names, right? You're just kind of seeing the stock market, maybe the major indices, are starting to kind of base out, but you're finding individual stock names that are kind of ahead of the curve, above those key averages, looking for those higher lows, potentially breaking out. In the trough phase, you're kind of getting that recovery, right? And we kind of went through this cycle pretty quickly in recent, right? When Trump announced the tariffs that were put into place, we were kind of seeing a quick contraction as the tariffs started to get delayed. We hit that trough early recovery, and now we're kind of possibly in a late. We hit expansion like from April to I think now, and I think now we're kind of in like between a peak contraction phase, right? So we'll go over some of the economic reports as well. In real time, but you can kind of see here how putting everything together, you can kind of gauge where in the economy we are, and by doing so, you can kind of see what kind of industries will gain favor, trying to look for, trades, look for setups in those industries to kind of gain those with those tailwinds, and kind of what industries or what kind of sectors to avoid as well. All right. So that's pretty much everything I want to go over in terms of economics, kind of the major data points there. So next we'll kind of go over what are the main resources that we can use, right? So the main resources that I use for my financial information, the first one is forexfactory.com. And I like this resource really well because it kind of breaks it down in very simple terms, right? So right out the back, you have pretty much, you can filter into what key data points you're looking for. So I have it filtered to kind of these red folder news. So pretty much how this works is the expected impact. Your red folder, your orange folder tend to have a bigger impact on the economy. They tend to be more widely looked at, and you'll see kind of them have direct impact on stock prices. And your yellow folders, your gray folders don't really have much of an impact. So I kind of filter it to only the red and the orange. And since I'm trading US markets and I'm in the Canadian markets, I will filter it down to the Canadian and the USD currencies, right? So after doing so, get a nice kind of filtered list here, and it kind of has information pretty concise. It tells you what the forecasted is, what the kind of actual came out, and it also has a graph on previous data releases, which can help you establish, what the trend in those reports are looking like, right? So here you can see Joe's job openings. Also really like that if you click the detail folder here, you can get a nice breakdown as well as what exactly that economic data is telling you, and also why it's important for the economic market. So really good resource here. Forex Factory. The other resource I use is Financial Juice, right? And this is for my intraday, day-to-day basis, as it kind of updates news in real time, but also provides here on the side a calendar that you can use also. I think my dad also, I don't usually use this resource, but Trade Economics. Trading Economics. So this is also another really good resource as well. I'm pretty sure my dad has showed you guys this one in the past. But for me, I like to use Forex Factory as it does kind of give us a good gauge of, what are those key data points, what is it forecasted to be, as well as what that impact is for the stock markets, right? So Forex Factory and Financial Juice. So if we kind of go to Forex Factory, let's take a look at some of these key economic data points, right? And kind of gauge where kind of on the economic cycle we are, right? So the first number we'll take a look at is GDP, right? So we're going to get a bunch of data points tomorrow. So GDP tomorrow, we'll see how it comes out. So again, forecasted 2.5%. The previous one was negative, right? So we did have negative growth in the last quarter. So we'll see how today prints. But if you take a look at the graph, right, and I kind of put a line chart here, you can kind of see we're kind of in a very like shallow downtrend here, right? So GDP is decreasing, right? If we're looking over a month-to-month basis, it is heading to the downside. So that does show signs that the economy is possibly contracting. We're not really seeing, factories operating at excess capacity. We're not really seeing that growth. And again, this could be hurting Trump a bit, right? Maybe why we want to see kind of the turnaround, why you want to see a lot of these companies start to manufacture in America. But GDP has steadily been decreasing. You can see that during COVID is a bit of a wild times, right? You kind of saw mass panic in the market, kind of saw a very quick move through the economic cycle, right? You kind of saw a quick contraction, trough, and then a pretty heavy and just as quick on the reversal on that expansion, right? So kind of smoothed out since, but you can see that since then we're kind of just curving, making these lower highs here. So GDP is falling, right? So economy is contracting in that sense. The next number we'll take a look at is the unemployment rate, or let's see inflation, right? So tomorrow on Thursday we're gonna get that core PCE number. So we'll take a look at what the chart is telling here. How is inflation looking? Kind of steady, right? We're not really seeing, back in 2020, 2022, 2022 was kind of a bear market where we were seeing interest rates really rise as inflation was becoming an issue, right? We were kind of seeing year over year growth expanding as we were kind of got this quick recovery off that COVID, right? COVID was a time where market was in extreme panic, right? Oh my God, we can't leave our houses anymore. People are dying from this very serious disease, right? And it's caused mad hysteria, right, in the overall economy. But then as things started to improve more gradually as vaccines started to work. People started to really care less, started to go out more. Then the market started to kind of boom. We also had a lot of government stimulus kind of pushed into the market as well at that time, right? And that was kind of overheating things, right? People had a lot of disposable income that they were just not spending because they couldn't go outside. They couldn't really go out anywhere. So they were kind of pushing it into a lot of your meme stocks like GME that exploded, also increasing disposable income really rapidly. A lot of your crypto, like your NFTs, remember SPACs, remember all that kind of stuff. So a lot of that stuff was overheating the economy really quickly, and we kind of started to see this uptrend here in your inflationary numbers, right? And then in 2022, when it was kind of reaching, in kind of late 2021, when it was reaching that peak, you kind of had the Fed being a bit more hawkish, starting to raise interest rates in that kind of fall in that 2021, and that led to a really sideways and downside equity market in general, right? And then since then, we kind of have been flattening out, kind of been decreasing as well. So inflation, not too bad, right? It is a steady rate, and it is kind of just holding sideways, so not a bad indication there. And the last number we'll take a look at is the unemployment rate. So let's see what the unemployment rate trend is here. So also kind of holding steady, right? Not too bad here, kind of just still holding in a general pace on a sideways move. So we're not really seeing too much kind of concern in the market. So off this data point, right, with a GDP steadily decreasing, it does tell me we're possibly in kind of a late peak stage. We're not really expanding, right? We're not really in kind of the top of the peak, but we're maybe starting to pull back, maybe entering into that contraction. But we're not really getting too bad reads here in the unemployment rate or in the inflation rate, which we're kind of seeing why the Fed now could expect to cut rates, which could also lead to a potential turnaround. So we'll see what we plays. Again, we could see a cycle now where we get a very short-lived trough, and then we can start to kind of expand very quickly if we start to see the Fed, decrease rates in September or in November, December, right? So I would say right now, again, we are in that late stage peak in contraction, but we could see a very quick trough, and then we could start to expand just as quick depending on what the Fed decides to do, and we'll get a bit better gauge of that in the oncoming news sessions, right? So that is pretty much everything I want to go over in this lesson, guys. Thank you so much for joining me for this economics class. I hope it gave you guys kind of a better sense of why this economic data is important, right? And how you can pretty much infer from like a general sense, right? You don't have to be too bogged down on the day-to-days, like what is happening today. Okay, what is the outlook in tomorrow? What's the outlook the next day? But just get a general sense of, okay, what kind of trend is some of these numbers heading in, and what is that telling me about what the state the overall economy is in? And then once you kind of gauge a sense of that, it really helps you determine what the market sentiment is looking like, right? From a day-to-day perspective, it helps with the day trades. Right now, we're kind of seeing a very cautious sentiment as a lot of these numbers are coming out, but we'll see as they get released if they're bullish, if they're bearish. We'll get that intraday reaction as well. And then also for your swing trades, it helps you gauge pretty much, what kind of industries could be booming, right? In times of expansion, in times of growth, you can really, play heavily into your high risk growth, your technology names. And in times of contraction, you can look more for your laggards or some of your materials, your staples, some of your more defensive, your like commodities type of investments. All right. So again, thank you guys for joining me. I hope you guys found this information useful. And I will pause the recording there.